Good morning, I'm Chris Beach, and welcome to Chart of the Markets on IG Live. And it's a slightly more positive start to the day for European and US markets after a 500-point gain on the Dow yesterday. Further gains expected on the open for Wall Street, actually. So it looks like the buyers have come in today ahead of the big events later this week. Of course, it's the Fed decision week. It's Apple earnings on Thursday and payrolls on Friday. So there's plenty going on to keep markets animated, really. And that's the major driver, I think, for the time being, that we'll see where we have the key things to see what the Fed has to say later in the week. What Apple earnings do, always key, I think, for market direction, particularly, of course, for the big tech stocks, the magnificent or the not so magnificent seven, as they've been over the last few weeks. And then payrolls, always a key one to watch out for. Month end, of course, as well. We're 1 month into Q4, and it's, of course, not been a great start to the quarter, but October can be a fairly volatile month for markets, and not just in the fatal years of 2000 and 2008, but overall it does often see a resurgence in volatility, and that's what we're seeing. What we have seen, but indices overnight and into today have seen some recovery off their lows. It's not much recovery, particularly for European markets, but it has to start somewhere, and that's perhaps where we'll keep the focus over the next few days, particularly with so many key events. Not much to report elsewhere into the economic data, although China saw its manufacturing sector dip back into contraction territory overnight for October. So not much good news there. And of course, we had the Bank of Japan decision overnight. And that was, again, the Bank of Japan never really likes to make things easy for anyone. And while it did say it didn't really officially bring to an end its yield curve control of holding government bonds at 1% or the 10-year 1%. It did essentially say it's now more of a roving target than an official limit. So we did see some renewed strength in the dollar against the yen. And commodities just easing off slightly, really lacking a major catalyst, not that we're exactly short of big headline news at the moment. We're starting with the FTSE 100, and the indices currently trading FTSE at 7364.8, and that's up for a second day in a row, back above, as you can see, 7300. And interestingly, I suppose, bouncing off this support zone that has held since the beginning of July, really. The index, indeed, you go back all the way to March, and that was where the buyers came in as well. So a key zone has to be said here, and that's always my view, that you have to take support and resistance as areas, and buyers tend to step in. And just as you can see on the way up here in July and in September, we pushed into 7,700 but couldn't hold above it, and then the index dropped. You did see plenty of volatility around these levels at the turning points, and that's always the problem, I think, trying to call turning points in markets. They're rarely obliging enough to be calm and easy. They don't just stop and then go back up again. You usually see quite a bit of a battle between buyers and sellers. That's what we saw at the beginning of July here, finally, before it started to take off, and then again in mid to late August around 72.80 or so, and again over the past 2 or 3 sessions. On the flip side, of course, if we do see continued gains, then what we're looking at is 7,700, because that's where the rallies have stalled since the middle of July. So those are your key levels. FTSE 100 stuck in something of a trading range, which is great if you're looking for those kind of trading ranges. It's not really developing into a longer term trend, but it's a reminder here, particularly that markets go up and down. They don't go up or down. They can do both over the course of time. And that's exactly what we've had the FTSE 100. Plenty of volatility, but not much overall movement, which is, of course, frustrating for some and great for others. It depends on your view. And that's sometimes markets work in one way for people, and sometimes markets do another thing. In terms of the DAX, we're up for a second day, back above 14,800 again, only just, but certainly, again, these March lows, buyers coming in again, for whatever reason, of course. And this is the key thing, looking at charts. We're not concerned with the why. We're merely concerned with what is happening in front of us, and that's what we've got right in front of us, is buyers stepping in at the same levels that they did back in the middle of March. For whatever reason, European stocks, the DAX, seen achieve these levels relative to whatever, but that's just putting a slight dent in the losses of the past few weeks. And I say slight because, of course, the DAX has seen an awful few months. Back on the 1st of August, hit a record high. That proved to be the peak for the time being. And not surprisingly, after the huge gains we'd had from October's low, the index gaining some 40%, we then had a pullback of around about 11%. We're still firmly up on where we were a year ago, but obviously it's been a very dramatic pullback. Now, in one sense, it could still be fairly dramatic, even if we get a big rally, because if we argue for trend line resistance being the thing to watch, then we could go all the way back to sort of 15,200 here and still be below that trend line from the August highs, which has been the key thing holding back progress since then. Of course, you've got a declining 50-day moving average as well. So it's not looking great in many ways for the buyers, because the trend last few months or the past year hasn't been firmly shattered since August. And there's a lot of work to be done to get it back. It'd have to really hold above 15,500, I think, to really say, okay, we've seen the end of this pullback, and that's a good 600-700 points away from where we are now. So a lot more to be done. In the short term, if we want to draw yet another trend line, which is always interesting to argue for, you could say this is sharp trend line resistance from mid-October high up at 15,588 or so has been broken. So that's an interesting change of pace here. Maybe gives us some short-term upside. And the initial thing to look for, of course, is around 15,000, because that's where buyers stepped in at the beginning of October. Couldn't hold it above there, but they did step in. So that's perhaps a possible area of resistance on the way up. And over to the US, an absolutely storming day for the Dow yesterday, and doing very well in early trading this morning as well for the futures, back above 33,000. The May lows in this case, once again, I could say holding, but they were rather breached over the past week, really. That sudden drop on Friday to the lowest levels since March for the Dow very rapidly reversed. And again, it's still hard to argue for a much more positive view, but then again, it always is at these times. There are plenty of reasons to be cautious on stocks. Earnings haven't been great. You've got central banks still perhaps committed to hiking rates, and of course the war in the Middle East with the potential for escalation, sadly, there. So there are risks to the outlook at this point. But nonetheless, maybe we'll see some short-term upside, at least towards trendline resistance here from that late September, so the mid-September high could come in play near 33,500. We'll see what the index does after that. Initial gains take us on to the 200-day and then 34,000, which is where the rally stalled in the first half of October. Looking at FX markets, we continue to see strength in the euro here ahead of the Fed meeting this week. And after falling back from the 50-day moving average last week, we're now edging above it for euro dollar. Nonetheless, it's still a long way to go before we can say we're back in an uptrend. We're still very much in the risk zone for a lower high. It's perhaps not surprising to see a recovery in euro dollar in the short term. It's the kind of thing analysts say when something has moved a lot in one direction, something is bound to happen. Eventually it does. It's just impossible to say when, but there it is. We've got the rally there from 104.60 back up to the 50-day moving average. It's the question of what it does next, really, as ever. But we're still, even really if we get to 107.60, we're still very much in lower high territory, but that might be an interesting thing to watch for. Certainly a reversal in the next few days back below 106 here would be a negative development. It wouldn't take much to really take a bearish view with the price dropping back, and the MACD crossover once again here, bearish one, would signal more declines for euro dollar. But short term certainly is on the up, hoping, I suppose, if you're a euro dollar bull, for a fairly dovish Fed, a fairly cautious Fed at tomorrow's decision. Holding rates unchanged is the general expectation. It's a question of really what the statement says about future moves on rates, particularly given, of course, the strength in oil prices. Then we'll move over to pound against the dollar, and again a modest recovery here the past couple of days, not really seeing the same strength that euro dollar has yet to test trendline resistance from its late July high after this huge downtrend. So still a little bit more work to be done here for the sterling bulls in the short term. We're still backed by a rising daily MACD, but as with euro dollar, we've got a declining 50-day moving average. It's back below the 200-day moving average, which of course is a change from what we've seen almost all year since January. So there's still argument for looking to sell into strength rather than buy the dip. Of course, it depends on your view. But I think for the moment, anything that sees the price falter back below 123 has to really count in the lower high category, even if you get, as with euro dollar, a break above trendline resistance. So a lot more work to be done here for the bulls before you could safely say perhaps this isn't recovered. Although I would note, as ever, there's always something to keep an eye on. But this 123 area is key, because that's where the bounce in mid-October stalled. It's also where, during the course of the rally, we found support in late May after a pullback. So that's going to be an area of previous support that is now resistant. So one to watch for if and when we get there. And then finally, dollar yen. Up above 150, really markets issuing the challenge now to the Japanese Ministry of Finance about intervention in the yen. So you do have to be wary of this, but it was probably bound to happen at some point, unless the BOJ came out really, really hawkish and announced a really definitive end to yield curve control. As ever with the Bank of Japan, as I said, it was very much erring on the side of caution, if not, I might say, deliberate obfuscation to make things slightly unclear for markets and leave the uncertainty there. But we are rallying here, absolutely stonky day for dollar yen back through 150 once more. A close above it would, of course, be or say the close above these highs from last week would be the key, and could see fresh moves to the upside really develop, and that takes us on then to the 24th of October highs from last year, 151.94. But very much a defiant move from markets here towards the Bank of Japan and the Japanese Ministry of Finance saying, now intervene if we dare you. I think that's the key thing to bear in mind. That if you are looking at this, even if you're trading intraday, be aware that if we do get intervention, then it will be volatile and it could be quite an impressive move, I think, really. So do just bear that in mind. Nonetheless, the broader uptrend that goes back to July and indeed well beyond that, still firmly intact here as well. And then turning to commodity markets, weaker dollar gave strength to gold prices at the end of last week. We saw gold finally move above 2,000 once again for the first time since May, and then just ease back on Monday, but holding on relatively well, I think, despite the rather tough outlook for if we get a stronger US dollar. So that's something to bear in mind this week, of course, the Fed decision and payrolls on Friday. After the size of this move, it's difficult to really say that we could expect it to continue in that kind of impressive vein. Although, if we do get, I suppose, the most obvious thing that everyone's thinking about is escalation in the Middle East. Unfortunately, if you do get that, that might be the thing that drives gold prices back in further towards those highs from May, and is something to be aware of. But the close and holding above 1984 as an area of resistance when we were falling during the course of July is certainly an interesting signal in one instance. And beyond that, the next move takes us on, as I say, to 2060 and the highs from May. Short term, though, again, just as we're saying with euro, dollar, and cable, expecting some kind of pullback in the trend. In that case, a retracement rather than pullback here. We could be expecting some kind of drop that takes us back down towards 1940, but leaves the overall bounce intact, and that's yet to arrive, of course. But it's the kind of thing maybe we should be aware that something could develop, perhaps if you get a slightly stronger US dollar in the shorter term, with 1940 and then the 200-day moving average being obvious potential areas of support. Oil prices, of course, took a drubbing yesterday, once more dropping below trendline support from early October. So that's an interesting development. This rally isn't certainly quite the same as its predecessors in July and August. The buyers aren't having it all their own way. It seemed like we were back in oil rally mode during the first half of October, but we faltered, dropped back in, dropped below the 50-day moving average, dropped below trendline support from that October low, holding a little bit today, but hard to muster a particularly optimistic view. Maybe we see price rally back towards 84 and then start to drop once again. Just look at this intraday as well. It's always the key thing to bear in mind. And sometimes if we can't get back above 84, we can't get back above even 83.50, then it would be obvious that sellers appear to be gathering strength in crude oil prices after their substantial bounce from the July lows. Obviously, the China data overnight not helping matters really. The signs that Chinese manufacturing dropped into contraction is not a great sign if you're expecting oil demand to remain resilient into the end of the year and beyond. But for the moment, sellers more or less in charge here. Close below the October low at 81 would obviously generate further negative expectations that we go back down towards these late August lows, and then indeed the 200-day moving average. Bulls would need it back above 84, back above the 50-day to be a bit more confident that actually we've seen a reassertion of the uptrend that's been in place since July. So we look at the rest of the day. Of course, it is payrolls week and not Fed decision. So today's a bit of a warm up. We know we don't get too much this afternoon apart from US consumer confidence at 2 p.m. Don't forget, of course, that with UK clocks having changed the weekend just gone, US market open is 1:30 our time rather than 2:30 as normal. So just be aware of that one. We're expecting a positive start to the day. The Dow starting the day around 33,050. That's about 130 points up from where we were yesterday. So still looking fairly strong as we prepare ourselves for the big week, big events to come in the second half of this week. But that's it for me. Thank you for joining us. We'll be back as normal tomorrow at 10:30.